Welcome back. Happy Friday. We want to take a look at the various markets and how they've wrapped up for the week. We've had a pretty big moves to the upside in equity markets and some pretty interesting moves in the fixed income markets as well. First off, let's take a look at the S&P 500. The top left-hand side shows us a number of dots. Every dot represents one stock within the S&P 500 index, and this is on a scale of 0 to 100 in regards to their respective RSI relative strength index. The right hand side, and we can see it's pretty evenly grouped between the 45 to 65 range, right in the middle of the trading range. We can see the histogram bars on the right hand side show us the number of stocks within each RSI relative strength basic window. So for example, we have 137 stocks that have a relative strength index of between 55 to 60. We have about 116 stocks between 50 and 55. And we have another 107 stocks between an RSI of 60 and 65. So the vast majority of the stocks in the S&P 500 have a relative strength index of between 50 to 65, right in the middle of the range, slightly above parity, but right really in the middle of the range. Now, if you remember earlier this week when we were seeing very negative stock market performances, we had the RSI closer to the lower end. The RSI is pretty reactive. When stocks rally, we have had some pretty good rallies in the stock market the past couple days. We see the RSI has moved. However, consider the bottom charts, the green charts on the left-hand side shows us each stock, same S&P 500 index, but in this case, we're looking at each stock within its own respective 52-week range. And the vast majority of the stocks are still near the lower end of the range. On the right-hand side, this shows that we have 49 stocks that are at the 20 to 25% level of their own 52-week range. So imagine a stock has a yearly range of $1 to $100 a share. We'd see about 49 stocks that are trading around $20 or $25. We have another 47 stocks with a 52-week range of around 15 to 20% of their overall yearly range. So you can see while the RSI has reflected that stocks have bounced off their bottoms and the bounce has been pretty good, notice in terms of those same stocks in their own 52-week ranges, we're still near the lower end. This cluster of stocks, the vast majority of the stocks in the S&P 500 are at or below the 35% level of their own 52-week ranges, meaning that on a scale of 1 to 100, most of the stocks are trading between $1 to $35 a share. Very few stocks are near the upper end of the range. Point being, if we see more negative news, we could see a reversal right back down near the lows. The RSI is reactive, but it takes a lot more to drive these stocks up towards the center of the range, which so far it hasn't. So although, stock market performance in the past couple of days looks good, it hasn't really repaired a lot of damage in terms of the prices yet. Maybe if this continues, but we're not there yet. Really quickly, in terms of FX markets, we can see the Thai baht is the strongest currency in the list, followed by the Israeli shekel, Aussie dollar, Mexican peso. At the bottom end, the Turkish lira is number one as far as the weakest currency, or the currency with the weakest RSI. The Japanese yen is number two. Now, this does make sense because as markets go up, traders tend to buy higher yielding currencies like the Thai baht or the Israeli shekel or the Australian dollar, and sell the lower yielding currencies like the Japanese yen. Lower yielding currencies are those that we put our money into in a flight to safety. But when stocks going up, Japanese yen pays almost 0% interest rates. Better to put in a higher yielding currency, which is exactly what we're seeing now. In another look at this, we see the Japanese yen. That has bounced off its low. It did have a 28 RSI as of yesterday, now has a 32, but certainly very close to the low. Thai baht has an RSI of 63, Israeli shekel at 60, and the biggest moves up we see in the Norwegian currency, South African as well. So certainly very interesting to see how that plays out. But as long as we see strong stocks, I think you continue to see weakness on the Japanese yen side. As far as the bond market, which I think is the most interesting story, we see here, top right hand side, the red line represents the total bond yields across all the different bonds added up. We see yields still continue to rise in the anticipation of higher interest rates. Federal Reserve Chairman spoke yesterday, indicated as such. The blue line represents the S&P 500. It's a pretty dramatic bounce off the bottom, but the stocks are going up as yields are going up. That doesn't make sense. I don't think both can last, because as interest rates move higher, this tends to weigh heavily on the stock market. So I don't know if the stocks will reverse back down to the downside, or maybe the anticipation of higher interest rates will wane. I can't see that happening. More interesting than that, though, the correlations which we saw for quite a long time between the S&P 500 and, for example, the 30-20 bond spread. We have a 347 yield on the 30-year bond. We have a 371 yield on the 20-year bond. That did have a very strong correlation. I'll show you what I mean here. The black line is the S&P 500 moved down sharply, then really bounced up. Well, the 30-20 spread, the difference between the 30-year bond and the 20-year bond, it looks like it's followed course, but it hasn't performed, in kind. You could also compare the S&P 500 to the 10-20 spread. Again, S&P 500 breaks higher. This spread changed to some extent, but did not follow. Point being, we're seeing a break in between the behavior of stocks and bonds. Usually these markets are very closely tied together. This break in correlation, this divergence, might represent some sort of opportunity to either short stocks or short the yields, meaning going long bonds. But it'll be interesting to see which one happens. Again, remember, stocks move in anticipation of corporate earnings. Bonds tend to move in terms of the anticipation of economic conditions. So when they don't always align, that's where you see a divergence between the two. The orange area chart represents the S&P 500. Move to the downside since the top we saw in July. Big snap higher. Now the green line represents the culmination of the spreads of the short-term bonds. Short-term bonds, the yields have been going up as the prices obviously are going down, because traders are selling the short-term bonds. They're nervous about the near-term future. They say, I don't want to buy a short-term bond. I'd rather put my money in a longer-term bond, like the 10-year bond. I know this because take a look at the yield on the 10-year bond. It's a 3.33. The 20-year bond is a 3.71. And the 1-year bond's a 3.67. You get more yield for a 1-year bond than you do a 10. That's telling me traders are throwing out the 1-year bonds and buying the 10-year bonds. They're more optimistic about 10 years into the future than they are about 1 year into the future. So what's happening is that as stocks are going up, we would expect traders to buy those short-term bonds if this stock market rally was real. Now, of course, it is real in the sense that stocks are going up, and if you're long, you're making money. But I don't know if this is sustainable. That's what I'm trying to say. That either we're going to see stocks reverse to the downside, or if this stock market rally is real, then maybe traders are going to go back and buy those short-term bonds, and the bond prices go up, and this green line will go down, and the inversion in the yield curve may disappear. But that really is what we're looking for. We're looking for the stocks to confirm the bond move, which indicates a negative future, or the bonds to follow the stock market, which over the past couple of days has been strong, and that reflects maybe a possible positive future. That is a divergence, and that's what really we're waiting to see how that works out. Now, something else I wanted to talk about. This is not something we're going to look at every single day, but it is really important. Now, the blue area chart here, the blue and gray chart, that's the S&P 500. These are, monthly updated prices, so that's why it's a little jagged. The red line is the average mortgage rate that we always talk about and always talk about in the news, and obviously mortgage rates have been going higher over the past couple months. The black line represents the discount window. Now, what is a discount window? The discount window is a central bank lending facility, and it's been designed to help commercial banks manage their short-term needs or short-term liquidity needs. And normally this is a very, very quiet number. This doesn't change very often. You can see it really did not change between April of 2020 all the way to March of 22. But the reason why it's important is because if the banking system, and this really reflects all the banks and the central bank as well, if they forecast, if they start to see trouble on the horizon, they will cut the discount window. This chart doesn't go back that far, but if you look at the discount window going back to 2007, 2008, they really started to cut the discount window. That makes it easier for commercial banks to borrow money. They cut the discount window. I should say the central bank cuts a discount window to increase liquidity, to make it easier for banks to borrow in anticipation of a crisis. Notice what happened in 2019. As the stock market was still going up. Remember, this is before the stock market really plummeted early 2020. In 2019, as the S&P 500 moved higher, the central bank started to cut the discount window. We were at 3%. We went down to, I believe it was around 1.5 or maybe a quarter. It was a quarter, 0.25. They cut that window, pretty dramatically. But a lot of the cut occurred even before the stock market crashed. Now, it stayed flat for a long time, and as the perception that we were recovering and stocks were going up, certainly the discount window did increase, all along with interest rates and mortgage rates, etc. It's not dropping yet, but we're going to look at this from time to time, and we're going to look for any signs that the discount window is reduced. If it is reduced, that is typically a warning sign that there's economic, trouble in the future. It doesn't happen that often. A year could go by before we see this thing move again. But we're going to keep it on the back burner. But I just want to let you know this is, what we're watching in the background. And sometimes you'll hear, on the news, they'll say, the central bank cut the discount window or they raised the discount window. This is what it is. Essentially, it's a central bank lending facility that's created to help, commercial banks, and they'll cut it when there's trouble on the horizon or when the banking system sees trouble on the horizon. So that's just one more element we're going to watch. So far, it doesn't say anything negative, but just wanted to, bring up to speed as far as where we are here, and we'll keep a very close eye on it moving forward. We hope this has been helpful, and we wish you all a great weekend.